Hello everybody, and welcome to part 13 of our series, Understanding Binary Options. In this particular video, titled Try Before You Buy, we're going to be talking a little bit about how we can experiment with binary option trading before we actually put money into it, hence the Try Before You Buy. In retrospect, I realize that's a little bit of a lame title, but it sounds appropriate. So let's get right into it as we normally do with a quick overview of binary option trading. Essentially, in binary option trading, we pick a commodity or currency or stock or index, and each of these has a current value at any given point in time right before we're ready to make a trade. Binary option trading relies on our ability to predict what the future value is going to be sometime, in the future, and we call if we think the value is going to go up, and we put if we think the value is going to go down, and being right gets us a percentage of what we put in, but if we are wrong, we lose all of what we put in. So for those getting into binary option trading or relatively new to binary option trading, there are a number of sites that offer risk-free incentives in the very beginning. An example of this may be a demo account with toy money, such that we get to make toy bets, and we don't win or lose any money per se. We see the amount change depending on whether we win or lose, but it's not real money. It's just numbers in our account, and this is essentially to ease us into the trading experience, so we get practice. The other thing that happens is that often trading websites as an incentive will make contributions to the trader's account, such that it's a little bit of our own money and a little bit of their money, and there I mean the site's money, but this often comes with quite a few conditions. For example, you're not allowed to redeem any of their money until you've made a certain amount of trades or bet a certain amount on the trades, stuff like that. So one needs to be very careful with this sort of contribution style incentive. But what's really going on here? Essentially, we're being eased into binary option trading, and we're trying to get into binary option trading without risking our own money. But is some sort of demo account actually necessary for this? And the answer is, of course, probably clearly no. It's very easy to simulate the process of binary option trading. All you really need to do is pick an index, hypothetically, pick the euro to the US dollar, pick a trade time, take a look at a trade, just see if it's 60 seconds or 30 minutes, what have you. Pick a direction, you can either put or call, and see what happens. So for example, I can look at the value of the euro to the US dollar right now. I can decide to call, and I can think that the value is going to go up in about 30 minutes, and after 30 minutes I can really see what the value is, and if it indeed went up, I was right. On the other hand, if the value did not go up, it actually fell, then I was wrong. So it's pretty easy to simulate what really happens in binary option trading. So given this, if we are going to simulate the process, how can we tell if we're doing well? How can we tell if we've got binary option trading down and we really know what we're doing? One of the obvious indicators is that we're right significantly, and I underscore that word. You can't just be right a couple of times more than you're wrong. You need to be right significantly more than when you're wrong. What that means is that if we're right more often than we're wrong, we can ascertain that the outcomes are not random. It's not just gambling. We know we have some sort of something that we're doing. Either we're following a certain strategy, or we really have good instincts, but we know what we're doing. It's not like we're randomly trading. And whatever strategy we have, it's most likely repeatable. If for a significant number of trades we were right more often than we were wrong, it wasn't just a fluke. We did it once. We did it several times, and we're probably going to be able to do it again. The other indicator is that let's say whenever we're wrong. But whenever we're right, we knew we were going to be right. Or we had a relatively strong feeling about being right. Now, I realize this sounds a little strange because it's like, okay, when you were right, when you thought you were going to be right, you turned out to be right. But if you didn't think you were going to be right, why did you bet? Why were you ever wrong, in other words? But what's really happening here is that when we say that the trades which we got wrong, they just happened to be wrong. But whenever we were right, we had a really good feeling about the trades that were we thought they were going to be right. But the ones that were wrong, we just happened to lose on those particular trades. But why is this important? I realize I'm being inarticulate here, but it's very important to grasp the concept of why, whenever we're right, we thought we were going to be right, because this means we can control the cases when we turn out to be right. So for those of you who may not know what I'm getting at here is, let's say there's a case when we don't know what the outcome is going to be. We don't know if we're going to be right or wrong. Well, in that case, it makes sense to bet a small amount of money. But let's say there was a case when, okay, I know I'm going to be right on this trade. This is the kind of trade where you want to bet a large amount of money. So what we talked about in point 1, we don't have to be right significantly more than we're wrong. I can be right as many times as I'm wrong, but whenever I'm wrong, if I bet a small amount of money, but whenever I'm right, I bet a large amount of money, I'll end up doing well in the long run. So both of what we talked about, 1 and 2, both of these are good indicators to tell if we're doing well. But for point 2, we should note that point 2 is a pretty weak indicator. It's still useful, but the reason I say it's pretty weak is because, honestly, how can you really tell if you're going to be right? Whenever you're right, you knew you were going to be right, but whenever you're wrong, you kind of were shaky about it. That's even a little bit weaker than point 1, I would say. I mean, though it is important, these two are very important concepts. One is essentially the frequency with which we're right as opposed to when we're wrong, and 2 is whenever we're right, we want to make sure we made a significant amount of money on the times that we're right. So both of these are distinct indicators, and they're both important. And of course, ideally, we want to have both of these, and that's important to note. So, having discussed this, I decided to perform a little experiment, and this is actually the reason it's been a while since I produced a new video, because I was busy collecting a lot of data. So what did I do? I simulated 1,000 different trades by myself. It's exactly the way I described it. I didn't place any actual money on any of the trades. All I did is pick a trade and then decide whether I was going to call or put, and then actually look at the value at whenever the trade expired and see if I was right or wrong. My trades were distributed across different stocks and different indices. For example, sometimes I think I even picked commodities, and they were uniformly distributed. I distributed this across 5 different sites. So I think it wasn't 200, 200, 200, 200, but it was, I think, roughly about that. And some of the sites I used were TradeRush and OptionBit and such. But it wasn't just one site. That's the focus here. I tried different kinds of trades. For example, I tried some of them 60 seconds and some of them 30 minutes. Normally, I'm not a big fan of 60-second trades because I don't think they're reliable, and we'll talk about that in a different video. But in this sense, conducting 1,000 different trades is a little time-consuming, so I went with the 60-second trades. And the reason I did a number as large as 1,000 is because I'm distributing this across a number of different variables: the kind of stock, the kind of site, what kind of trade, the time limit, and I wanted to be thorough, so I wanted a large enough data set. That's why I did 1,000 different trades. And I used some of the strategies that we discussed in earlier videos, but for all practical purposes, each trade that I went with was independent of the other. And of course, I kept track of how many I got right and how many I got wrong. So let's talk a little bit about the results. What happened? As it turns out, I got 553 of the trades that I made out of the 1,000 right, and I got 429 of them wrong. 18 of them were ties. What I mean by ties is, let's say I picked call or put. Could or Paul, that was stupid. Call or put. The value actually, when the trade expired, turned out to be exactly what it was when I had made my trade. So in this case, I was neither right nor wrong. So 18 of these cases, nothing happened. There was no right or wrong. If I had bet real money, I wouldn't have made anything. I wouldn't have lost anything. But 553 right, 429 wrong. And it doesn't matter whether it was call or put. I had no bias either which way. 553 right, 429 wrong. This seems encouraging. Why does it seem encouraging? Because the fraction of the number of times I got it right to the number of times wrong is non-trivially high. What do I mean by non-trivially high? Trivially high, it doesn't seem like a coincidence. The ratio of rights to wrongs is close to 1.3 actually. That's significant, I would say. So in terms of the first bullet point that we talked about earlier, it does seem that the fraction of times, the number of times I'm able to get it right as opposed to the number of times I got it wrong, is certainly skewed in the direction of right. This is good. But there's a caveat. There always is a caveat. The maximum rate of return for any of the trades I took part in was about, well, not took part in, simulated, was 81%. In fact, it wasn't even 81% for all of them. That was the maximum. For some of them, it was about 67%, and for some of them, it was something in the 70s. I tried wherever I could to get the 81% trades, but you don't always have control over that. But as high as it ever went was 81%. So let's take an evaluation of this. Let's say I had bet an amount of A each times, and you can put anything in A. It's $100, $10, $5, what have you, whatever amount you're comfortable with each trade. So let's say I had bet A each time. The total losses I would have incurred are 429 times A. That's because I was wrong 429 times. So each time if I was betting A, my total loss would have been 429A. But the total money I made would have been 553 times A times the rate of return, 81%. Remember, whenever you're right, you don't get back all of what you don't get double of or anything like that. You get a fraction of what you put in. So to say that I got 81% of 553 times A is the same as saying I got about 447.93 times A. So the total money that I made is not 553 times A, but it's rather 81% of 553 times A, which is 447.93 times A. So I have my total loss and I have my total money that I made. So what's my net profit? It's the difference between these two. So I took 447.93 A, and from that I subtracted my loss, 429 times A, and I got 18.93A, which for our purposes we can assume to be 19A or about 20A, whatever you want. Now, if I'm going to make 1,000 trades, and it turns out I make a net profit of about 19A, in order for this to be cost effective, A has to be significant enough for me to turn a real profit. What do I mean by that? On average, if I'm betting just $1 each time, and after 1,000 attempts, I made a profit of 19A, which is $19, that's no good. I mean, no one wants to spend that amount of time and put just get $19 out of it. So what's a good amount for A? It's hard to say. Supposing A was $100, then I would have made about $1,900. Now that's not bad. I could always use $1,900, but if I'm betting $100 each time, what does it mean? The total loss would have been 429 times 100, which I mean, if you're okay with losing $42,000 at any given point in time, that's good for you. But for me, that's really not feasible. I can't imagine myself betting $100 on each trade. I mean, it's great in terms of the fact that I made my money back. I mean, I hypothetically would have made my money back, but $100 every trade, if I had lost 429 trades, and let's say the 429 trades that I lost were in the beginning, and then after losing 429 times, I ended up winning 553 times. I mean, I realize that's unlikely, but just for the sake of example, if I had just kept losing $100 each time, I would have been very disappointed, and I probably would have given up. So, one needs to have that level where one is comfortable trading with a certain amount of money. For me, I think perhaps $100 would be too high, and honestly, the amount that you bet needs to be regulated each time. As we talked about earlier, if there's something where you are really sure that you're going to win, for whatever reason you're sure you're going to win, you want to bet more there. But if there's some place where you're not confident, you want to bet less there. But on average, though, we're dealing with averages, so essentially whatever amount we're betting with on average, it needs to be significant enough for us to turn a real profit. And in this case, even if A was a number like 10, that means our total profit would have been $190. If one is betting about 1,000 times, that involves a lot of time. That involves a lot of researching the trade. That involves a lot of time spent actually making the trade and looking at the results, etc. Even after 1,000 trades, it's one thing that we didn't make a loss, but even if we made a profit about just $190, that's probably not good enough in my opinion. Anyway, that's just my opinion. I just wanted to give the math out here for you guys and give you the results of my experiment. So that's about it for this video. We basically talked a little bit about the incentives that a lot of binary option trading platforms will offer to customers to ease into the trading process. But based on our experiment, which anyone can do, by the way, there's nothing special that I did here. All one requires is a little time and patience and internet connection and maybe a computer. But anyone can essentially do this. True, there may be some small errors, the timing is important and things like that, but if you do it for a large enough number of trades, in my case it was 1,000, you'll see how you're doing. And if it turns out you're approximately right as much of the time as you're wrong, and you don't have control over when you're right as opposed to when you're wrong, and therefore you can't regulate how much you bet on the times you're wrong or the times you're right. You can't regulate that. Then binary option trading is a lot like gambling. But if you are trying to get into this and you are trying to see how good you are, this is, in my opinion, it's a great way to start. It eventually it becomes something of a litmus test for you to decide. Okay, before I'm going to put any real money into this, I want to see if I'm able to actually control the outcomes of these trades, and if I know I'm going to actually make any money. I think that this in fact is one of the strategies which you can use to evaluate the other strategies. If you think you've got a good strategy, you should be able to try it and test it, and it should hold up against such a test. So I think that's about all I want to say for this video. If you like it, please go ahead and subscribe and leave comments. Any and all feedback is welcome. And I guess I'll see you in our next video. Thank you very much.